That means if I have a problem, 1/4 times 2/3, it's
Morning. How's everybody doing?
Good morning.
Morning, morning. This is it. This is it. Last class. Woo-hoo. All right. Let's give a few more people, see if anybody else is going to show up, and we'll take a look at our review problem. 17.5B. I'm going to get my answer key rolling here. Alrighty. All right, 17.5B. Yeah. All right. Just give me 1 second. My washer's going, so I want to close the door in the laundry room. Get a refill of coffee. Could you close that door there, please? Yeah, I just don't want the washer. Thank you. Coffee. And we're rolling. I'm live. I'm live. See you later. Okay, guys. Let me make sure you can see my screen. Okay, so you should see at the very bottom here, 17.5B. We're going to get rolling, take a review of this, take any final questions we have, and you'll be ready to take your final exam, which is only on chapter 17. You'll be able to finish your homework, your Tableau assignment, and be done with the class. Before I get into it though, let's just remind you of due dates for everything. So on May 10th, which is Sunday night, Chapter 17's graded problems, Tableau, SmartBook are all due. Monday, May 11th, you should have your final exam completed by 11:59 p.m. So then Tuesday, and please, let me remind you of this. It's important because this sometimes Connect, you know, is a little unforgiving. So if you give me any information on how you made your computations for your answers in Connect, because if you're off a decimal place or two, it's going to mark it wrong. So please read the instructions really carefully, especially on the final exam and that graded problem. So it tells you how many decimal places to carry it out. And be careful if it's asking you, and it'll show it as a percentage in the answer. If you get 0.2345, you want to make that 23.45 in your answer. So you may have to be converting stuff into percentages. So just be very aware of that. But if you're still getting answers marked incorrect and you're like, I know I did it correctly, remember I have that Dropbox and Learn. Just forward me any kind of detailed calculations. And I look in there and I say, okay, you know, Chelsea wants me to look at certain questions, and I'll go into your Connect account and I'll look at your final exam. If you don't send me any detail, I'm not looking at it, okay? So please make sure you do that. Even if you take pictures with your phone, if you're like, I can't get it into Blackboard, into the Dropbox, email it to me. I'll be looking at that on Tuesday and getting your final grades together so that you can see them in Blackboard. One other thing, I just opened it a few minutes ago on grading. So this is from my boss telling me how I should be grading. And really it's focusing on anyone who is receiving an incomplete, which none of you are in this position, but I award a final grade Students will have 7 days from Wednesday, May 20th at noon. So from May 20th at noon to May 27th at noon. If they want the option of replacing the letter grade they receive with a PS, which would replace a C or better, or a PD, which replaces a D. The significance again of these two designations is that they do not impact your GPA. So if you don't opt to change it, which they're going to send you information on how to do that, they just didn't send it out yet. If you don't change that during that time period, you got that letter grade. So please keep that in mind. As far as I know, if you fail the course, you do not receive an F. So, well, it's not automatic either. And so this is it says students will also have the option to withdraw after the course grade is awarded. The W is not a passing grade, and it signifies that the student withdrew from the course and will need to retake the course in order to complete it. A W is not included with the GPA calculation. Now, it says in my number 6, all F grades awarded will change to a W, and hopefully nobody's in this position, because I think if you're actively engaged here, you're not going to fail the course. But if you are in another course, you're like, I don't know if I'm going to swing it. I don't know if I'm going to get that D. Always, I would still alert the registrar's office or whatever the guidance is they give you that you want any F grade changed to a W. It looks like they're going to automatically do it, but I wouldn't count on it. I would just do it anyway. That's my advice. And you requested the W. Okay, W's will not affect your GPA. So be careful of this, especially with your financial aid and any kind of restrictions you have if you fail a course or get a certain grade in it. If you want to know more about how these things impact financial aid, I would contact them, but I don't see that. And this is my opinion. I don't know everything about financial aid, but I think if you change it to one of these scenarios, your financial aid isn't impacted. That's my opinion, but double check on it. Are there any questions on that? Okay, so watch your mail. You've got to keep watching your LCC email every day, even when you're finished with your classes. And maybe there'll even be guidance provided in Student Planner where you access your grades. But they're going to somehow contact you and let you know that now you can opt to change a letter grade to one of these others, depending on what your original letter grade is. All right. Any questions on that? Excellent. All right, so you should see the answer key. Okay, so let's take a look at 17.5B. So we have summary information from the financial statements of 2 competing companies in the same industry. They just made them up, Fargo and Bell. Okay, so we have information about the company's assets and liabilities. So their income statement or the balance sheet. I don't even know what I'm talking about. The balance sheet. And then we have information about each company's income statement. And then they also give us beginning balances of certain items from each company's balance sheet in the right bottom box there. So let's look at requirement 1. Here's what they want us to do. Compute these 6 ratios: current, asset test, accounts receivable turnover, inventory turnover, day sales and inventory, and day sales uncollected. So those are our liquidity and efficiency ratios. And notice it says round to 1 decimal place. Make sure you read those instructions. I've got to tell you, it's not in this Connect, but at Penn State, I use a different platform. It's Pearson's. It's my accounting lab. And oh my goodness, they were freaking out when they took their final exam. People were getting 40s on it and stuff because their final exam is really the same thing you take, but in a different platform. And it was all because of the way they entered their information. They calculated it correctly, but the entry was incorrect. So just be careful of that. So read those instructions. Identify the company you consider to be the better short-term credit risk and explain why. Now you're going to have to do this in the final exam, but it's not going to be an essay type of question. It'll be drop-down box. So you'll have choices. So just be aware of that. You're not just going to do calculations. And you guys kind of get a more scot-free because in the classroom, I make you explain each ratio, okay? But this time around, I can't really do that. But I can help you start, show me that you're understanding we got to use this information to do some analysis and get that ball rolling. All right, so let's take a look at that first ratio, the current ratio. Make sure you understand where all the numbers come from. Remember, that's current assets, total current assets, which for Fargo Company, we would need to add together. So they just don't give you current assets. You need to add the 20,000 cash to the accounts receivable of 88,700, to the merchandise inventory of 86,800, and the prepaid expenses of 9,700. So that's where the 205,200 comes from. And then they do give you current liabilities for Fargo of 90,500. So we have here 2.3 to 1. Do the same computation for Ball Company. Cash, 36,500. Accounts receivables net, 79,500. Inventory of 82,000, and their prepaid expenses, 10,100. So 208,100. Divide that by their current liabilities of 97,000. So 2 to 1. So again, what does this ratio mean? Anybody want to take a stab at it? All right, I'll tell you. I've got to change this up if we go live. We do this in the fall. I said, I don't know if I told you guys, I'm getting a whole whiteboard across all my windows in the back of my office here. And I'm going to be standing up and everybody's going to have their videos on. But you guys are the test and I hate not seeing this. Anyway, so our current ratio for Fargo means they have $2.30 in current assets for every dollar of current liabilities this year. Their competitor, Ball Company, has $2.10 of current assets to pay $1 of current liabilities. And if you think about it, isn't that what we're calculating here? We're taking all the current liabilities and dividing it into all the current assets. So that's giving us a ratio here. So Fargo is better able to pay their current liabilities with current assets than Ball Company is. Any questions on that? Let's go to our next ratio then, the asset test. Remember now the asset test is where we take really liquid current assets. So we don't include all current assets, that's the current ratio. This includes really liquid assets though, those that can be converted to cash very quickly, and divide that by current liabilities. So we're just focused on here, cash and accounts receivables. Now, if this company or either company had short-term investments on their balance sheet, they would be added in as well. But since they only have cash and accounts receivables, those are the two liquid assets that are in the numerator. Divide that by the current liabilities of 90,500. So Fargo has $1.20 in very liquid assets to pay $1 of current liabilities. So they have even more in almost cash assets than they have in current liabilities. And it works out. Ball Company has the same exact thing. So they're right in line with one another. We took Ball Company's cash and accounts receivables, added them together, 36.5 and 79.5, 116, and then divide by the 97,000 in current liabilities. So they're equal. Remember, asset test is now just focusing on really liquid current assets. Current ratio, all current assets. Any questions? Ooh, look at this one. Wow. Accounts receivable turnover. The calculation, the formula is net sales divided by average accounts receivables net. So net sales for Fargo will come off of their income statement, $393,600, divided by the average accounts receivables for the year. Remember, whenever it says average, we have to find the beginning of the year's accounts receivables, which is on the right-hand side, 72,200, added to the ending balance of accounts receivable, 88,700, and then divide that by 2. And that average is then divided into the 393,600. Fargo is 4.9 times. What does that mean? Fargo collects their accounts receivables on average 4.9 times a year. So they collect on average, that means. Some people, some accounts, they may collect more times during the year, some may be less times. So we're averaging the overall amount of time, or how many times we collect all of the accounts. Ball does the same calculation. Their net sales, 667,500. Beginning accounts receivables, 73,300. That's on the right-hand side. And then their accounts receivable balance of 79,500. Add those two together, divide by 2. That's your average. Then divide the average into the sales. They're 8.7 times. So they collect their accounts receivables 8.7 times during the year. They're doing much better at their accounts receivable management than Fargo is. They collect their cash almost double the times that Fargo does. So we're just saying, I'm not going to sit here and go, why? I'm just identifying that they are much better at collecting their money than Fargo is over here. Any questions on that? Then I'm going to just go down to F. We'll come back up to D and E because F kind of goes with C. Days sales uncollected. Now let's see how many days on average it usually takes Fargo to collect their money. We find that by taking accounts receivables at the end of the year, divided by sales for the year, and then multiplying that by 365. So accounts receivables at the end of the year, 88,700, divided by sales for the year of 393,600, and then multiply that by 365. It takes Fargo from the day of sale on account or credit to ultimate collection of a cash, an average of 82.3 days. So some people may pay their accounts quicker than 82.3 days. Some may take longer. This is an average. Ball Company does the same computation. Their ending accounts receivable, 79,500. Sales for the year, 667,500 times 365. They collect their money within 43.5 days. So it takes Ball Company about a month and a half to collect their money. It takes Fargo almost 3 months from the day of the sale. You think about 3 months is about 90 days. Yikes. So Ball Company gets their money much quicker. That means they could buy more inventory. sell more inventory, and make more profit because of the way they collect their money. So Fargo is much less efficient. They have a real problem compared to Ball company in their same industry, with collecting their money. Any questions on that calculation? Okay, let's go to then our final two in step one, which is inventory turnover and day sales and inventory. Now we're measuring how well we sell inventory. So in C and F, how well we collect our money from sales on account. D and E, how quickly or how well we manage our inventory, because the quicker we get it out the door, the more money we make. So our inventory turnover is found by taking cost of goods sold for the year, $296,600 for Fargo, and dividing it by average inventory balance for the year. So below the income statement information, they tell us the beginning balance of inventory is 105,100. There it is right here. And the ending balance on the left-hand side, 86,800. Add those together, divide by 2. That's your average inventory for the year. Then divide that number into your cost of sales or cost of goods sold. 3 times. Ball does the same calculation. They have 480,000 in cost of goods sold. They have beginning inventory of 80,500. Make sure you could find that. Ending inventory of 82,000, which is on the left-hand side information. Add those together, divide by 2. Take that average into their cost of goods sold, 5.9 times. So this is telling us, on average, how many times they have to replace inventory a year, or how many times they sell out of their inventory, on average, a year. It takes Fargo 3 times. Ball doubles that. They're able to sell their inventory out 6 times during the year. So if you're going, well, that's good. Well, that means they have more gross profit from their sales because they're selling and selling and selling twice as much as Fargo. They're doing a great job compared to Fargo with managing their inventory. Now, let's convert that to days. So let's see how long it actually does take in terms of days to sell the inventory from the day of purchase to the day of sale. So take ending inventory for the year, which for Fargo was the 86,800, divided by cost of sales, and then multiply that by 365 days. 109 days for Fargo. Do the same calculation for Ball over here. Their ending inventory, 82,000. Cost of goods sold, 480,000 times the 365 days. It takes Ball about 62.4 days to sell their inventory from the day of purchase. That's 2 months. It takes Fargo 109 days. That's 3.5 months. So Ball is managing their inventory much more effectively than Fargo is. Are there any questions on that? So now, based on our analysis here, we could see Fargo does a little bit better with paying their current liabilities with current assets than Ball. They're about the same when it comes to their asset test. But Ball blows Fargo out of the water with their accounts receivable management and their inventory management. So knowing this, which one has a better short-term credit risk? Meaning we could loan them money on short term and they'll pay us back. Which one is in a better position to do that? Ball and Fargo have nearly equal current ratios and asset test ratios. However, Ball both turns its merchandise and collects its accounts receivable much more rapidly than Fargo. So that means they're converting their inventory to sales and sales into cash much more quickly than Fargo. So on this basis, Ball would be the company that would be the better short-term credit risk. If you loaned money to both these companies on a short term, within a year, they owe it back. Ball is in a better position to pay it back than Fargo. We're not saying Fargo won't pay it back. We're just questioning which one is in the better position to do it. And this is the kind of analysis that you would be doing on the final exam. But you won't be typing this all out. It'll give you drop downs. And maybe like it'll say Fargo and Ball have, and it might be blank here, and you'll have to select some sentence, complete the sentence from a drop down. Are there any questions on that analysis? Okay, let's go to our second part of our problem. Now in part 2, we're going to be looking at, it looks like, profitability ratios and market prospect ratios. So they want us to compute the profit margin ratio, total asset turnover, return on total assets, return on common stockholders' equity. Assume that each company paid cash dividends of $1.50, and each company's stock has a market value, so it can be purchased at $25 a share. Then we're going to compute their price earnings ratio and dividend yields. Round to 1 decimal place for part B. Round to 1 decimal place. For part B, which is asset turnover, round to 2. Then identify which company stock would be a better investment. Let's take a look. The first ratio is the profit margin ratio. This is where we take net income divided by net sales. So Fargo's net income, it's given on the right-hand side of $33,850 divided by net sales, $393,600, 8.6%. Do the same computation for Ball. $61,700 is their net income. Their net sales for the year, $667,500, 9.2%. So what does this tell us? The amount of sales the company retains as net income. So of all the sales they have, 8.6% of them are net income for Fargo, 9.2% are for Ball. Now, if you're going, well, okay, what's the big deal there? Well, what is net income? It is what the company made from their operations this year. Two things that could happen to net income. The company retains it and uses it to grow the business, or they pay it out as a dividend, or a combination of both. So Fargo is not as profitable as Ball Company when it comes to this ratio. Ball retains more of their sales as earnings for those two distinct things that could happen to it than Fargo does. Are there any questions on that? Asset turnover. What we do here is we take sales divided by average total assets. Average total assets. So we need to know, what are our total assets? For Fargo, The beginning of the year, they're 383,400. They give us that information on the right-hand side. And then the end of the year, they're 382,100. Add those two together, divide by 2, determine an average, divide the average into sales, 1.03 times. So what this means is for every dollar of assets, average assets, the company is able to generate $1.03 in sales. Or they say times here. So just like inventory turnover is how many times we replace inventory, it's how many times we earn sales on our assets, 1.03 times. So that's another perspective. Or you can say for every dollar in total assets, the company makes $1.03 in sales. Do the same thing for Ball Company. Their net sales, 667,500, divided by their average total assets, beginning 443. That's on the right-hand side information. And then ending would be the 465,400. Divide that by 2. The average is then divided into their net sales, and they get 1.48 times. So every dollar of assets for Ball, they generate $1.48 in sales. Or from a turnover perspective, you can say they are able to take their inventory and make sales, or I'm sorry, take their assets and make sales 1.48 times. I like the dollar to $1.48. It just means more to me than that turnover. I'm not thrilled about turnover stuff, but it's all on your perspective. Maybe you love it, and that's fine. But it means those two different explanations of the same ratio, whichever one you can grasp better, or if you love both. Are there any questions on that? Profitability. So far, Ball retains more of their sales as income and are able to generate sales better from their assets than Fargo. Now, the return on total assets, we talked about this the other day. Now we're identifying a percentage, and you could think of it as like an interest percentage. And what we're doing is looking at, okay, here's all the income, net income the company made using all these assets we invested in. So if we take net income of the company, 3,850, divided by the average total assets, again, just like we calculated up above in B, use the same information. Divide the average total assets into the net income they produced, 8.8%. So it's almost like saying, if this company was a bank, they earned an 8.8% interest rate on the money invested in it. Now, Ball Company, when you do their calculation, they have net income much higher, 61,700, divided by the assets they used to generate the 61,700 in net income, which is the same as above. They create a return of 13.7%. So Ball Company is able to take their assets and generate a much higher return, percentage-wise, than Fargo Company is. They're more profitable. And that's how we could identify that. Look at the percentages there. Are there any questions on that? Now we just isolate and look at how well do they make income for their common stockholders. Just that group. Because they're kind of in the dark. They don't really know what they're going to get. Creditors, if the company borrows money from a bank, the return to that bank is the interest. And that's identified on a document. The company doesn't go, oh, you want me to pay you 7% interest? No, I feel like paying you 10%. No, they're just going to pay 7%. So that's the most the creditor will ever get from loaning the company money. preferred stockholders. They're in the same boat. When they buy preferred stock, it's stated right on their stock certificate, the highest dollar amount they'll get of net income from the company. But these cats, the common stockholders, they kind of give their money in the dark. And they go, I don't know what I'm going to get. I'm hoping I'm getting something. I have the most risk here. So we want to identify and give them information. Here's how well the company generated a profit from the money you gave us since you're in the dark. So we take net income. Now, if this company had preferred stockholders, which I doubt, let's see something very quickly here. Yeah, if they had any preferred stockholders, which they don't, neither one of the companies, we would have to identify the amount of net income that would be going to them first. Because remember, the company makes net income for preferred stockholders and common stockholders. But since there is no preferred stockholders, we don't have to subtract any preferred dividends. So all the net income is going to this one type of owner, the common stockholder. Now divided by the total amount of money they have invested in the company, which would be total, average total stockholders' equity. So the $133,000 in common stock plus the $65,600 in retained earnings would be added together, and we get $196 or $198,600 for their ending common stockholders' equity. The beginning, we would go over to the right side. For Fargo Company, it would be the 133 common stock plus the 49,100 of retained earnings. So that's where these two numbers came from. You needed to do some addition there. Just don't take the common stock, add the retained earnings balance, then divide that by 2. So that's the average amount of the common stockholders' money in the company. Divide that into the income, net income the company provided using that money, 17.8%. Ball Company will do the same calculation. Again, they're going to use their net income divided by their average common stockholders' equity. Common stock beginning would be 141,000 plus retained earnings of 109,700. So that's the 250,700 here. And their ending would be the 141,000 plus 129,100, which gives us the 270,100. Add those together, divide by 2. That's the average amount of money the common stockholders at Ball Company have invested. The company took that money, generated a net income of $61,700, 23.7% return to the common stockholders. So we can see here, Ball Company uses the money from their stockholders to provide a profit much better than Fargo does. Fargo only generates them a 17.8% return on their investment. Ball Company, 23.7. Questions?
Is on the test, it's gonna be like this because it takes time to calculate everything.
Oh yeah, yep.
Oh
Yeah.
yeah, all this?
Yeah, you're gonna do all these calculations and you have 2 hours. You'll be given
Okay.
2 hours and it's only one chapter, right? And my suggestion is have these formulas right in front of you from the book. I would use that great summary of ratios on page 627.
Okay.
Okay?
So how many problems is on the test?
Let me finish the problem and then I'll take a quick look at it. I can't remember.
Okay. Scare me.
I created it back in December, so I can't remember, but I'll take a look at it.
Oh, okay. Okay, no problem.
All right, no problem. Okay, let's look at these last 2. and we'll wrap up this problem. The next, so just so we remember, these 4 ratios are measuring how profitable the company is. Okay. Now, price earnings ratio and dividend yield are what we call market prospect ratios, or they're identifying if you were somebody in the market, how well they're giving you a return on your money within the market, within the stock market. So here we have the price earnings ratio. You'll hear it referred to as the PE ratio. We take the market price per share. So common stock, market price. Now they told us in the problem, both companies have the same market price, $25. Divided by earnings per share. Now on page 645, on that second, the right-hand column, very bottom, you could see, well, right in the middle of the page of that first group of information on the income statement, I should say under net income, basic earnings per share for Fargo Company, they calculated and said is $1.27. Ball Company is $2.19. Now, just to review, earnings per share is a very important number in the market for investors. So if you know nothing else about these ratios, if you don't even know they exist, you know earnings per share exists if you buy and sell stock because it's quoted so much. And market people who buy and sell stock react to that. It identifies how much earnings the company makes for 1 share of outstanding common stock. So Fargo makes $1.27 for 1 share of outstanding common stock. Ball Company, $2.19. Now this ratio, price earnings ratio, when we complete the division there, Fargo's is 19.7, Ball is 11.4. I like to put a $sign in front of it, which your author doesn't, people usually don't, but I like to, because I think you could wrap your head around what this is by looking at it as it's the amount the stock will increase or decrease if earnings per share increases by $1 or decreases by $1. The general explanation is it's the value the people who buy and sell stock place on $1 of that company's earnings per share. So if earnings per share of Fargo Company increases by $1 or decreases by $1, this ratio says, then the price of the stock should increase by $19.70 or decrease by $19.70. But for Ball Company, it's $11.40 price change. Okay, so that's what it's telling us. So there's more change dollar-wise in Fargo stock than there is in Ball stock. Dividend yield is our final calculation where we take annual dividend divided by the market price of the share of stock. So the annual dividend per share, which is given, and they said both companies have the same dividend. So this is the actual cash you're going to receive, $1.50, if you buy 1 share of stock for $25. So 6% is the actual return, the cash return, if you buy 1 share of stock. So this is for investors who may be looking and going, hey, I want an 8% cash return, or I want a 3%. So how you use it depends on your investment objective. We're just showing you here, they're equal. They have the same dividend yield. So one more time, profitability wise, Ball is much better. All of their ratios are higher than Fargo. Price earnings ratio, the market values $1 of earnings per share of Fargo, a little bit more than they do Ball, but they have the same dividend yield. So that's what you're doing in your analysis, and that's what this is going to say. Ball's profit margin, asset turnover, return on total assets, return on common stockholders' equity are all higher than Fargo's. Ball has a lower price earnings ratio while paying the same dividend. These factors indicate Ball stock is likely the better investment. Okay? Just from that profitability standpoint. Are there any questions on that? Okay, so we've looked at all the ratios except for those few solvency ratios, which you'll see in your exercises. But I'm just going to, I'm not going to share my screen, but I'm going to take a look at the exam quick. And there goes my dog. Just came back from his walk. Give you some information on the exam so you can prepare for that. And remember, have it done by Monday night. Let's see. So we have, oops, like 3 or 4 multiple choice, just because I have to throw some multiple choice in there. We want to know vertical analysis and horizontal analysis. There's a problem on that. Oh no, there's more than, okay. Sorry, there's about 10 multiple choice. I lied, or 11. There is a problem where you're going to do these various calculations, various ratios. So know all the ratios, how to calculate them. Okay. So 2 problems, 2 big problems. So one is no horizontal, I'm not going to tell you which one. I think you do both, horizontal and vertical analysis in the problem. Similar to what we did with our homework problem. And then just like we did with this homework problem, you're going to have a set of financial statements. You're going to have to do the various ratios and complete the analysis through drop down. And then there's 10 or 11 multiple choices. Okay? Any questions?
You said 10 multiple choice, and how many? The other one, I didn't get it, sorry.
10 or 11 multiple choices. Know that horizontal analysis and trend analysis, like we did in our homework,
Okay.
horizontal and trend, and vertical analysis, and those common size financial statements. Remember, common size financial statements are just the vertical analysis. You don't use the dollar amounts in your financial statements. You just use the percentages you calculated in vertical analysis. And then all these different ratios. So again, you'll have 2 hours to complete it. Send me as much information and details through the Dropbox or email. And be careful of the directions. Read the directions carefully, how they want you to enter the answer. Anything else?
Okay. Sounds so scary.
Yes. Yes, shoot me now. Shoot me now.
Tanisha, stop that. You'll be fine.
Just give me my F now.
Oh, stop that. Stop it.
It's not that bad.
Yeah.
Guys,
Yeah.
just make sure you know what you're doing.
Oh, okay. Chelsea already took it?
Yeah, I took it on Saturday.
Okay. So there you go. Chelsea's already been through it. She said it's not bad. Be careful of the ratio. Be careful of the number.
Yeah, be careful. Make sure you read the directions. The decimal points are important. Make sure you actually know what you're doing, how to calculate like current assets and all that things. And I'd say do the calculations first and then worry about the multiple choice last.
Yeah, I agree. So find your two problems and get all of that done. Worst comes to worst, you just guess at the multiple choice at the end, right? They have the least point value. I think
Yes.
it's a piece or something.
Yeah.
Excellent advice.
Like it took me about an hour to do all the calculations.
Okay.
Uh-oh.
Oh,
Be
man.
honest.
No, but
You'll
I am
be-
the person that I used to like have to put a 0 and I put a 1. I don't know why, but I always have that problem.
Wow.
I hope
You'll be-
doesn't happen this time.
You what?
I hope that's not gonna happen this time.
Yeah. Well, just send me, like I said, if you show me in your formula, you know, I took this number divided by this number, I could go, okay, yeah, you did it right. It's just maybe you didn't put it into Connect the way they wanted it. Or maybe even you didn't put it in your calculator correctly. I'm not going to take all the points off because of one or two issues like that. Okay?
Okay.
Anything else, everybody? This is it. Woohoo! Sorry, this is my happy day. Well, thanks, everyone. It's been a interesting but great semester. I appreciate all of you attending these live lectures. I pray we all get back into the classroom in the fall. And if you have any questions on anything, just email me. I'll be around all summer too. Hopefully I'll see you in the fall. Take care.
Take care.
Thank
as
you,
well.
Professor. It was a
Thank you.
pleasure.
Thank you.
You
Professor
betcha.
Don.
Bye.
Thank you.
Bye.
Bye.